Good morning, everybody. This is Deanna Morgan. I am here with your Fun Fact Friday, and I am going to go over the Fed meeting and a little bit of information about what the rate hikes mean to mortgage-backed securities and interest rates and things like that. So it might be a little bit longer video, but I just wanted to share some information with you so that we can explain everything. So, stocks are lower this morning after a 3 day rally, with mortgage bonds are higher to start the day. They're rebounding off of a support and now higher than they were before the Fed rate hike. As we have been saying before, mortgage bonds typically like the rate hikes because the Feds are fighting inflation. St. Louis Fed president and voting member Jim Bullard is the first Fed member to speak out to the media post after the Fed meeting. He was the lone dissenter who wanted a 50 basis point hike. He said that he wants the Fed funds rate to be above 3% this year to fight inflation, which would imply 12 rate hikes. He also thinks that the Fed should have already started reducing their balance sheet. This is an important note because Bullard can often be the outlier at the Fed and sometimes extreme thoughts. So the Fed governor voting member Christopher Waller said that the Fed may need to hike 50 basis points one more time in the coming months to tame inflation. He also said that the Fed needs to start reducing their balance sheet more soon in the next meeting or two. He was very out of tune in his comments where he said that there was no chance of recession because recession is probably on the horizon. The Fed was so accommodating and watching inflation go from 1.75 to almost 8%. Now they changed their tune and so where they said that inflation has kept rising, they said that it would be transitory. Several of the members who have since resigned were profiting from the Fed's buying. We are in this position because of the Fed, and they're also the reason that we see the boom and bust cycles. The Fed now wants to get ultra aggressive, but historically, when they get too aggressive and they push too far, it pushes us into a recession. So, existing home sales also were measured here recently, and it shows sales down 7% in February. This is likely measured activity from December and January, where rates were rising, but not at the levels that they are today. This is a bit worse than expectations, but coming off of a similar rise in the previous month. On a year-over-year basis, sales are really only down 2.4%, which is quite miraculous considering higher rates and home inventory, home prices going up and home inventory being at an all-time low. So, speaking of inventory, there were only 870,000 homes nationwide for sale this year, or for sale last month, which is up a little over 2% from the record low last month, but it's still down 16%. And very distressed levels. From July, the inventory is down about 33%. There is only a 1.7 month supply demand nationwide, and 6 months is considered to be balanced. So we're really, really short on demand. And homes were only on the market for about 18 days in February, down from 19. So this should continue to be supportive of home prices. The median home price was reported to be $357,000, which is up 15% year over year. This continues to be skewed by a mix of sales on the lower end and down sharply when sales were above 500,000 were much higher. So first-time home buyers actually accounted for 28% of sales, which is up slightly from 27%. Cash buyers declined 27 to 25%, and investors are still purchasing 19% of homes, but it's down from 22%. Foreclosures and short sales actually account for less than 1% of all transactions. And next week, we're going to bring more important housing news. Pending home sales will be released, which will show signed contracts on existing homes. This will give us an idea of the level of demand with current rates. New home sales is also coming out, which measures signed contracts on new homes, and that's also going to be released. And mortgage bonds are actually higher right now. and they're bouncing off of higher points over the last 2 days. Basically, what this means is we could see a little rebound. Interest rates could get a little bit better, but it is going to be short term. So give us a call if you haven't updated your pre-qual, or if you were on the fence and you weren't sure if now is a good time to buy or refinance. We may have a little bit of a reprieve, but it may only last a few days. Give us a call, 972-755-4876. Thanks so much. I hope you enjoyed this information today. And if you have any questions, just give us a call. Have a great weekend. Talk to you later. Bye-bye.